All right, my friends, had some folks ask me about some Right Capital software questions. So let's go into this. We're going to do how to do Roth not Roth conversions, SPIAs, single premium income annuities. A little bit of a background to do that. It's not quite as clean as I'd like, but it works. And I get why the software doesn't allow you to do it as crisply as you'd like. I'll show you that. And then I'm going to show you how to change your investment allocation. Then I think there's another one guy want to know about interest rates. We'll talk about that. All right. So let's first and foremost. Now, in this case, I'm using my man Dustin Tibbetts over at Jazz Wealth. I got to set up with Dustin my own personal account. This is not my personal stuff. It's just for me, if that makes sense. It's my practice account, so to speak, that Dustin allows me to use, which is great. I think Dustin's got some new software coming out, by the way, which I'm very much looking forward to seeing how that shakes out. I think he spent a lot of money on that, so I'm looking forward to seeing that. All right, so basically what we're going to do, I'm doing a SPIA. My man Kevin asked how to do a SPIA. So we're going to go to Profile. A SPIA is just an income annuity. And we're going to go to Income. All right, so Profile Income. And then you're going to go to Distribution. So you want to do Add Income. So Profile, Income, Add Income. And it gives you all these things right here. And then you want to click the Distribution one right down here. And when you do, you'll get this box that says Distribution. And what I did here is I put SPIA for single premium income annuity. Now, what you can do is you can say from where to pull it from. All right, so in this case, I'm pulling it from my 401k. Now, the reason why it's not as clean as a typical SPIA is because this will leave residual balance in there, if that makes sense. I'll show you what I'm talking about here in just a second. But it doesn't allow you to say 10 years from now, I want to do, it's not a deferred income annuity. Let's put it that way, where it says in 10 years, I expect the account to be worth $700,000. In that case, I want to do an income annuity from it. And thus I have no longer access to the principal, if that makes sense. It won't let you do that. And you don't want to be doing that stuff anyway. And the reason for that is because you have no clue what the account balance is going to be. You don't. And because of that, to assume that you're going to income annuitize the whole thing when you don't know, A, what the account balance is going to be, and B, it takes away your residual value. Because once you do an income annuity, it's irrevocable. You no longer have access to your principal. You don't. You have access to a monthly income stream. So don't model any kind of retirement plan on that assumption that I'm going to SPIA and never have access to it again, because it's such a crapshoot. You're really shooting blindly in that case. So, but in this case, we're going to say instead of doing an actual SPIA, I'm going to label it as a SPIA, but I have $10,000 a year coming from my 401k, and I'm going to have it until the end of both plans. So we're going to start. It's off from my 401k. So it'll ask you, well, who's the owner? It's me. It's my 401k. When do I want to start? In 2021. And when do I want to end? And I'll have it until when Charlotte dies, or if because we have her, I die before she. And I'm going to take $10,000 a year. I'm not going to increase it with inflation. Now, I'm not converting it to Roth. If you are converting it to Roth, you want to make sure that little tiny eensy-weensy little button is checked, and taxation is standard rule. Okay, so literally that's it. And then you just hit save. Now, what's going to happen is we'll go to retirement, and I'll show you the cash flows. And we go to cash flows here. And you'll see plan distribution, $10,000 a year. And that's essentially my SPIA. But I mean, here, if you go to accounts, the issue is with a real life SPIA, I'll show you, is that we have residual balance in our 401ks. In a real life SPIA, we wouldn't. And here we do. We have my 401k still has a value left over, even though I'm annuitizing it. So in this case, I'm taking $10,000 a year, not adjusting with inflation. And what you'll see is I think it's then it runs out of money right about there when I'm, basically when Charlotte survives me. So that's how you do that. You can watch the withdrawals from accounts, and we see we got $10,000 coming from the 401k, keeps going, and then it empties out right there. So at 84 years old, for me, the 401k is emptied because I've essentially SPIA'd the entirety. So it's not really truly a SPIA because it does, again, it does have a residual value, but I think it works. I mean, I think it works pretty well for what you're trying to accomplish, which is how much money could I generate from this at a certain point. That makes sense. So what happens, just as an FYI, let's go back to net worth, is this guy right here, that 401k is still growing. This is, I got 192,000 my 401k. It's still growing according to how it's broken down from my asset allocation. So let's just say I want to SPIA this, kind of a backdoor way of SPIAing it, but I want to do it 10 years. This guy will still grow according to the allocation of this fund or the investments that I have. And then once I hit that age of 10 years from now where I'm taking income off it, the residual will still grow, if that makes sense, but the income stream in this case does not grow anymore. Hope that makes sense. It's not quite as crisp as you might like it. I frankly have no qualm with the way they do this because I don't like the idea of modeling SPIAs in the future when you have no idea what it's going to be based on, none whatsoever. So again, I think that's kind of shooting blindly. So I don't recommend doing that. And this is pretty good because this will show you if you're taking $10,000 a year out of an account that's worth $200,000. Yes, you will have access to residual, but it will go away. And that's unlike a SPIA. You don't have access to the residual, but it won't go away. So, all right. So, Kevin, I hope that answers your question. Let's see. Tom asked about how do you do different allocations. Well, this is grayed out your target allocation. So the only way to change your asset allocation is literally two changes. So you go to your profile. So what right now they got us right here. All our accounts are 25% U.S. equities, 13% international, and so on and so on. If we break it down, we'll see my 401k is 46% equities, 24% international. I think we got Charles' 401k is the opposite of that. So Charles' 401k is the Ginnie Mae. So Tom asks, how do you change it when this is a target right here? The target is just a default. So Dustin uses a 60-40. I use a 70-30 as a default. It's essentially meaningless in my opinion. But what you'd want to do is you have to go to profile. And then you go to net worth, which we're already here. And so we want to go to investments. And here I'll change this from a Life Strategy Growth Fund. We'll just change it over. We'll say add holding, and we'll make it Ginnie Mae as well. It always does that, drives me crazy. And what we got, 192,000 there. So we'll say how many shares do we have? 15,000. I'll say 20,000 shares of Ginnie Mae, and I'll show you what I'm talking about. Just for simplicity, we'll delete this guy here. Boink. There we go. And we'll see. Always got to make sure you save it, man. Always got to make sure you save it. And so what happens now if we go to investments, it'll show our allocations differently. So this still shows up as moderate, and current allocation is still 0%. Now 0% equities, 97% bonds. All right, so now we go to retirement. We click on that guy, and they'll be based on current plan, which is exactly what we have there, which is 0% equities and 99% bonds. If we want to change this to asset allocation to make it most aggressive, we can do that and hit refresh. Let's see if it does anything there. Probably, yeah, look at that. So you can change it right here. You just can't change the target at all. You can change your allocation. You don't even have to change your allocation. If you want to change your proposed investments to get a proposed plan, it lets you do that. You just got to click on this button right here. Then you can change all this stuff around when you want to retire, how much money you want per month to retire. And then you can go to cash flows. Actually, let's go to, let's see. Cash flows. And you see I have $10,000 coming out of the of our accounts. And this is proposed plan. Is always going to be proposed plan. So whatever you're proposing, and your proposing can be the same exact thing as your current allocation. That's no big deal. Remember, the proposed plan is always this right here. So what I'm showing what I'm talking about. If you go to current allocation, you'll see it's proposed and current are the exact same thing. All right. So we go to current allocation, we go to cash flows. The proposed is the current because we've nothing has changed. Proposed is literally the current. If we go to back to analysis, retirement analysis, and we go to we'll say aggressive, and we go to let's hit refresh. You'll see it changes there. Now we go to cash flows, and it'll say proposed plan, but now it's proposed plan with an aggressive investment allocation. All right, lastly, Tom said, hey, if I want to identify specific accounts, it's not going to let you go like, hey, I want to take out from this account for, like, it's not going to let you pull from a bond account, then a stock account. It doesn't do like that. It does it from, it'll take it from your taxable accounts, your tax deferred accounts, and then your Roth accounts. It doesn't let you do specific to the account. It would be proportionate to the account that you have. So if you have 50% in a Charlotte's stock fund, and you say, hey, I want to have 50% in a commodity fund for me, if they're both taxable accounts, it can pull proportionally from each of those. It will not pull from Charlotte's account and leave yours be or anything like that. But it will, again, pull from taxable, from IRAs and then tax-free first. That's the way it does it. And, rightly or wrongly, I mean, that's just the way it works, which works. Ideally, you can pay a heck of a lot more for software that lets you get a lot more specific. I don't think it's worth it, frankly, but I know there is software out there. Well, I should say no, because I don't even think eMoney allowed you to do that. And eMoney is the premier software, more on estate planning. But this is the premier when it comes to taxes. And for me, taxes, I think that's interesting more than anything. So that's why I like it the most. But eMoney does let you do for software for more specific allocation, investment planning, and estate planning. But when it comes for me, what I like is I like the tax stuff because I like this right here, the 1040. All right. So then Tom said, hey, how about interest rates? Now we used a very I don't know what Dustin uses here. Dustin, for me, my bond, I think I have bonds at 3, stocks at 7, or maybe I got bonds at 4. I think I have bonds at 4, stocks at 7.5, if I'm not mistaken. On average, stocks are 7.5. I think 8 internationally, 7 domestically, small cap 7.5. Government bonds are 3. Corporate bonds are, or maybe government bonds are 3 or 3.5. Corporate bonds at 4, 4.5, something like that. And that doesn't change. In cash, I have it, I think, 50 basis points. And so basically what happens in this case, if we go to your investment right here, it's allocated according to what your current, this target allocation is meaningless. It's your current allocation. And what it is in this case, and because I'm 100% bonds for just a scenario, it's going to say our portfolio is roughly 3.5% rates of return. All right. And Frank, I don't even know what Dustin's using for inflation. I don't know. What I use on my inflation, I use 3% across the board. The cost of living adjustments for Social Security is 2.6. So 3% inflation, 2.6 for Social Security. And Medicare expenses, I do inflate by 5%. I have no clue what Dustin's using here. There'll be something, it's just specific to the guy. So I've said this a million times. 2.6% for Social Security, 3% for general inflation, and 5% for Medicare. Bonds are, I think, again, 3.5. Stocks are 7.5. Dustin might be using something differently. In fact, I'm sure I could, if I felt like, I'm sure I could figure out what it is. I just frankly don't care. But anyway, so that's how we're using it. So again, whatever the numbers are being used is what's going to determine your success rate. So maybe it does say here. If Dustin is using, it doesn't say the projection rate of returns, but Dustin got all this other stuff, aggressive stock. So this is why I like Dustin and the guys over at Jazz Wealth, because they got all this different stuff in there, and I don't do that. Dustin actually manages money, and I like it. And I mean, I think the fee is actually quite reasonable for sure, and I'm a fan. And then you have access to all the stuff that Dustin does on a regular basis. We got a guy, Bruce, our man, Bruce Smith, a fellow traveler, for the Heritage Wealth Planning YouTube channel. He hires Dustin. He speaks highly of him. So, I'm all about what Dustin's doing. So, Andy's coming out with this new software, which I think is going to be phenomenal. If I know Dustin, he doesn't do anything half-ass. So very much looking forward to it, but that's, so by all means, get with Dustin. I mean, again, he's going to charge a fee. He's got to get paid. But if you want someone to look for, Dustin works for me. And I don't hire him because I just put all my stuff in Vanguard, be done with it. But I would have no qualm for someone going with Dustin. In fact, I'll do a review of Dustin's site because I'm a fan. I'm a fan of Dustin, and I'd like to have him send more business to him because I think he's a good guy, and I think I like what he's doing. So anyway, hope this helps, man. Hope this answers your question. If any questions, thoughts, concerns, put in the comments. And don't forget to thumbs up, subscribe, share, and we'll see you next time. Thanks now.